Good afternoon and welcome to Brunch and Budget on Bonfire Radio with your host, Pamela Capallet, a certified financial planner here to help take the bite out of your budget, brunchandbudget.com. I'm your sound provider, Dialect, and here's your host, Pamela Capallet.
Thank you, Dialect, and thank you, everybody, for tuning in. It is going to be an interesting week. We are going to be talking about something that actually a lot of clients have asked me about. It's been coming up a lot lately. You may or may not have heard of it. You may have used it as a borrower. You may have used it as an investor. It is called peer-to-peer lending.
Peer-to-peer lending, that sounds fun.
Yeah, right? I thought so, too, when I first heard of it.
Like if I got $1 in my pocket and you need $1, I lend you. Well, I guess I can't. Oh, no, I can't because I'm not a certified financial planner and you're not a sound provider. So I can't lend you that $1. That's how it works, right? You have to be peers in the industry. That's what it is.
Yes. I would have to be a rapper. You would have to be a financial planner.
This one actually ended up, this was my fault. I was looking up for a previous show and I saw this. I was like, oh, peer-to-peer lending. That sounds like a great idea.
For the investing show.
Right.
Yes.
I hadn't even opened it up. It was on the queue of I was going to read it. We do the research sometimes. And Pam opened it up and said, this is not what you think it is. This is we have, and I was like, wait, what is it? That sounds great. Well, let's talk.
It's not like Kickstarter for loans.
It's not Kickstarter for loans. It's not really anything.
Well, I mean,
it's something. It's not really anything related to that.
Well, our investment appetizer today is actually peer-to-peer lending, also known as P2P lending.
P2P.
If you've seen that, the number 2, P lending, peer-to-peer lending. So we're going to talk about peer-to-peer lending today, and I wanted to actually talk about what the hell it is, right? Because the name is a little misleading. And the thing is, in theory, you as a borrower need some money, right? You need to take out a loan for something, maybe medical bills, maybe covering some student loans, maybe consolidating your debt, maybe consolidating your credit card debt. And so you're
maybe you got a good tip on the horse races.
I mean, yeah, you could really use it for anything, actually. Maybe you want to fund a small business, And so the thing is that,
like I said, the horse races, right?
Yeah, totally. That's not gambling at all. So so with peer-to-peer lending, the way traditionally is you would have to try and get a personal loan at a bank. And we all know what happened in 2008, and we all know what happened when banks, got bailed out, is that they were leaving the money in cash and being very, very strict about who they lent money to. And so peer-to-peer lending actually became really popular right around the crash. And the way that it works is instead of going through a bank, on one side you have borrowers, so you have I need a loan, and on the other side you have investors who have money and who are looking to park it in a place that isn't just a savings account. They're too afraid to put it in the stock market. And basically what the deal is as a borrower, instead of paying 15 to 20% on your credit card payments, you pay maybe 7 to 10% at this peer-to-peer lending site to borrow money from these investors. And the peer-to-peer lending site is actually the one who holds the loan and is the facilitator of all of this.
Okay, so it's less percentages. It's got a non-bank institution involved. It sounds like good stuff. Because that's the thing.
Yeah.
People were distrustful of banks. Banks didn't want to lend out to anybody. No one wanted to go to loan sharks. This is like the solution, right?
Yeah, and actually for a while it was, and the solution was so good, and this is why we want to talk about it.
Was it too good?
The solution was too good, y'all. Well, here's the thing. Think about it. So if you, as a borrower, you get to reduce your interest rate by 7 to 10%, fix your payment, and say, oh, the debt is going to be gone in 5 years or 3 years or whatever time period you choose. And then on the other side of it is the investor. Instead of getting paid less than 1% at a savings account, you're getting paid 5 to 6%. So, the lending company takes their cut. But even after that, you're getting paid 5 to 6% every single month as long as the borrower pays you back.
Now that's some putting your money to work stuff.
Yeah. And we saw that a lot. And we saw a lot of success come from it. And so I'm going to stop there, and I'm going to call that the end of the investment appetizer.
Yay, peer-to-peer lending is a good thing.
Woo,
right?
In theory.
Oh.
Yes. Well, the reason why we wanted to talk about it, besides the fact that I've had a number of clients asking about it for years, and I've always been personally curious about it myself, but I was a little nervous to dip my own toes into it as an investor on the investor side, even though clients had asked me about it. And, I don't know how I feel about funding debt necessarily, and you know what that cycle is, especially without any education behind it. So I had my own issues with it on some level, but the returns were really quite attractive. So attractive, in fact, that mostly what's been happening recently in the last couple years is that institutional investors, so big ass investment banking firms, have set their sights.
Wait.
on peer-to-peer.
But I thought that the peers meant that we didn't have the banking in it. And also, I don't know if you guys have noticed this in your life, but anytime it's like you know how you put like the name of a city in front of a food, it makes it sound more delicious.
Yeah.
Anytime you put the word institutional in front of any word, it makes it
sound more awful.
well, it not sound more awful. It ends up making it evil.
It ends up making it, yeah.
It's like the goatee
The goatee
of words.
The goatee of words. Just guys with just.
You know,
guys,
it's
just
'cause,
shave
like,
it
there's your
off or
word.
make it a beard.
Evil twin. hey, look, I was my own evil twin. I had a goatee for a while. The beard, it didn't quite connect. Some my young brothers out there, don't worry.
It didn't quite connect.
Eventually, it'll connect, and you'll be able to have an entire beard.
Wow. Although the "it didn't quite connect" thing is very metaphorical.
Oh,
it
right.
didn't quite connect. These goatees of the lending institutions.
All right, yeah. Let's talk about this. Yeah, this
Yes.
institutional lending.
No
stuff.
more goatee talk.
So,
here's
yeah.
the thing. Here's what happened. So the thing is that these institutional investors started seeing like, wait a minute, these people are actually making a lot of money, and I guess technically helping people out of debt on some level. But the thing is too, it's like the cycle of debt was so good that and so many people had debt, as we know, and we talk about all the time on this show, that the concept I have to say is so simple and so easy to understand for any investor. It's like, oh, I'm just lending money to these people and then they're paying me back and then I'm getting a percentage of what they're paying me back, right?
The thing about debt that makes me nervous for what you're saying is, debt is so exploitable.
It is. And that's why it started getting a little weird when institutional investors got involved. And the biggest news most recently was, it's May 2016 now, for those of you listening in the future. The CEO actually ended up stepping down this month because they mishandled a $22 million loan for an institutional investor. It was basically, the way they invested it was against the actual express instructions of the client. And so they made a big mistake. And besides that, the CEO was also involved with he had a stake in this company called Sirix Capital, who also had investments in Lending Club loans. And so Lending Club went public in 2014. 2016, we find out that the CEO is doing these back end deals and not paying attention to how these loans are actually being invested and who's buying them. There's just like a lot of murkiness going on right now.
Can we quickly unpack what those two different things are for folks?
Yes, absolutely.
Because the first one, I can understand what's going on, but then he owns a part of the next thing. And
yes.
Also, what is it? So when you are when you're handling loan and investment advice, a lot of times you're just wrong, right? Just like a doctor, there's a difference between like a doctor making a mistake and malpractice. So the malpractice part on the loan side right here, is that he didn't listen to what they wanted.
Yes, he didn't listen to what they wanted. And so it was this investment firm called Jeffries, and they basically said one thing and he did the opposite. That's the simplest way to put it, is they said one thing and he did the opposite.
And that's not a common thing. There's not a lot of like cats who listen to their client and they're like, yeah, they said they wanted that, but I know better. And then
no, that's illegal. You can't do that. This is why there's so many regulations in place, and so many things that clients have to sign to say, yes, I agree to this, and this is what you're going to do for me.
And even on the low, it's not a common practice. That's not a thing people just do.
No. And then on the other side of it, so apparently the CEO, or the former CEO of Lending Club, had a stake in a company called Sirix Capital, and Sirix Capital is an investment bank. And the thing is that he, as the CEO of Lending Club, also owned a stake in a company that had loans in Lending Club. So they were an investor in Lending Club. And so it was just this weird double dipping thing, and it wasn't necessary because he didn't get fired. He resigned. He kind of got pushed out.
Is that specifically illegal?
It's just shady.
Right. I mean, it sounds funny style, but I can't find the...
Yeah. It's just like, you're kind of double dipping. You may be crossing the line a little bit. It could be construed as that, but there were just too many things in a row that the guy was just like, all right, I'm out. And actually a couple executives got fired for the $22 million mistake. So on top of that. So it was under his watch. And so what it looked like was the board was like, yo, we're going to ask you to resign right now. just
Well, yeah, I mean, it
be
sounds like
out.
too many things in a row.
Too many things in a row, for sure. So, I mean, here's the thing. The New York Times actually wrote this amazing piece in 2014 on while we were doing this research and Dialect saw some patterns, is that in 2014 people felt great about peer-to-peer lending.
They were very excited.
That's the year that Lending Club went public, and the New York Times was like, okay, hold up, let's take this down the logic train, right? So what's happening is it first started out as basically, and what was really great was like it first started out where borrowers could tell their story and talk about why they needed a loan, and you as an investor could actually read about like, oh, this person who needs this help, I'm going to be directly helping them, and potentially 25 to 100 more people, because you still don't put all your eggs in one basket, right? You're not literally like funding one loan to one person. But you read these stories about these people who you're potentially helping. And so that's how it's been marketed. And then you have these institutional investors come in because they see these returns and they're like, okay. So they're coming in. And what's happening now, what's happening in 2014, is they couldn't buy the loans fast enough. The demand was higher than the supply.
Well, the whole thing about institutional investors getting involved in a peer-to-peer, which implies at least one-to-one lending, that skews the whole game because they're buying up too much at once.
Yes, they're buying up too much at once. And here's the other thing is the reason why Lending Club was a relatively safe investment, or could be considered a relatively safe investment, is because they grade all of their borrowers. And they tell you, okay, this person has an A grade or a C grade or a B grade. And so that gives you an idea of the likelihood that the person is going to be able to pay back the loan. So it's based on credit score, income, job, all of these factors go into the grade. And you as an investor can say, I only want to invest in A grade borrowers. I only want to invest in B grade borrowers, C grade borrowers, right? And so what tends to happen is when you get institutional investors involved, like you were saying, and you have this like bulk of money, is they buy up large chunks, and then one day there are no more chunks to buy in the desirable or prime, should I say, loans. And so the direction that it seems to be going in is that perhaps Lending Club will open their floodgates or their loan gates to people who maybe are subprime borrowers. Does that sound familiar?
Yeah, well, while we're...
Not that I'm beating you over the head with it, but, yo.
Hey, well, while we're beating people over the head,
Yeah.
Can we get a little bit more of a description of prime and subprime? Because I think when people hear subprime loans, they think that was just a specific thing that happened in the mortgage crisis.
Yes.
And they don't... I know all of us don't know exactly what makes
that means.
Well, and what makes something subprime.
Right. Well, the thing is, the terms prime and subprime describe the type of borrower. So they describe the different factors. So prime borrowers are basically people who have a certain level of credit score, who have a steady job, who are able to prove 2 or 3 years worth of income, who are working for an employer and all of that kind of stuff, and who have a certain amount of income and, have a certain debt to income ratio and all of this stuff. And so there's all these factors that go in that rate you as prime or subprime. And so prime borrowers are above that line, and subprime borrowers are literally below that line. And so their credit scores aren't as good, or they weren't able to verify their income, or they didn't actually have the income that you needed to be able to take out this loan. But they got a little looser on the rules because, and what happened in 2008, or what caused 2008, was because there was such a huge amount of subprime mortgages going on, and so many of them defaulted that it crashed the market.
The thing that's ill about even having a name like subprime lending or subprime borrowers, when people were borrowing from a bank and you had like only 30 people going to a bank, There were people who had iffier credits, the people who didn't have a lot of money, but because it was an individual talking to an individual, they had a better ability to gauge whether or
Exactly.
not this person was able to pay back the money that they borrowed.
Totally.
And when it's just numbers, to really reiterate about why the subprime loan lending thing was such a terrible mistake is people knew that, yeah, I know people can surprise you and folks work hard and all that kind of good stuff, but in vast numbers, when you bring it out statistically, people were going to be unable to pay those loans, and folks just knew that.
Yeah, they just knew that, and they issued the loans anyway. And so that is kind of, and the market, granted, for peer-to-peer lending is nowhere near as huge as the mortgage market was. So this isn't necessarily going to cause another crash, but this train of logic and this thinking and getting these institutional investors involved in something that was meant to be kind of a one-to-one individual investor to individual borrower situation is really where the danger is, and that's kind of where it's headed. And I imagine that because Lending Club is now public, we go back to that, where do their loyalties lie? And we talk about this a lot because it really does affect a company's future business decisions.
It breaks the whole game.
It does.
That's the big of it. Don't worry about whether or not it's going to destroy the national economy, just like, the big thing with the banks. It's breaking this thing that was a good idea that works in a certain way just by flooding the market.
Yeah, absolutely. Absolutely. And the thing that's interesting is, and we're going to talk about this after the song, but there are a lot of startups now that are kind of doing this model. So there is Prosper that came out a couple years after Lending Club, actually like 4 or 5 years after Lending Club. And there's also these smaller companies that are actually lending to small businesses. And so we're seeing this happen. It's called Funding Circle is one of them, for instance. And so we're seeing this happen more and more, and this model happens. And part of it is the appeal of the model, on the investor side and the borrower side. So after the song, we're going to talk a little bit more about how it works. Does it make sense for you as a borrower, one? And does it make sense for you as an investor, too? Because those are the two questions that I usually get asked.
We're going to start off our first song of the day with someone I can borrow money from.
Ooh.
He's from Greensboro, North Carolina. Not only is he my peer, his name is Peer. He's got a song called On My Mind. And we'll check you in a minute. What's your budget? Bonfire Radio.
Yeah. Yeah. Lord, set him still, pushing Papa's whip. Still, borrow bread from mama scripts. Them Zans be helping me deal with shit, especially since I ain't been smoking for a bit. I've been on drugs since I was a little kid. Realized I was depressed when I was around 10. Struggling to fit in since normalcy I never did get. Always wondering why I was so different. I had reduced lunch, never quite made it to free. Never felt like anyone could identify with me. Never felt like I had anyone that could see my true identity. This duality, my brother played ball, always perceived as hooder. I used big words, looked at like a do-gooder, never a snooker. The beat butcher, living in the pressure cooker. I was never white or black enough, just other. Never quite up at the time, my waist just under. Grew up now, striving to be a world wonder. Show you what I've been working on all of these summers. Bruising my labor, you know I've been slaving. These raps gon' sound like they from that Turner when you play them. David Walker's the field, it's the real something in the safer. Striving to be more than a new flavor. Not a savior, just a disciple. Hold the microphone like a rifle. Bet arms on tracks, give life back to the stifle. State an arrival, I run unapproved to claim my rightful title. Check my vitals, power level over 9,000. To go against me now would be suicidal. The guy has no time for your trifles. Try to catch the wave, got caught up in the title. Forces, all these is spitting this bullshit. Thoroughbred right here, I'm not aiming for the Forbes. I'm just trying to pay off my parents' mortgage. I will never quit, never forfeit, never settle for just a portion. Because I want it all. It's been in my mind too long. Said I'm way too strong, and I'm come too far. It's been in my mind too long.
We're back. Bunch of Budget, Bonfire Radio. That was Peer with On My Mind.
Nice. Your peer.
Peer.
Your peer named
Yeah,
Peer.
he's
Is he
not-
peer-to-peering?
My peer, his name peer. He's not my peer. I guess he's my peer, but he's not my peer.
He's not your. Is he a peer?
He's a peer. He's everyone's peer. I
Oh,
assume.
okay. Yeah, I like it. All right. So speaking of peer, we're talking about peer-to-peer lending today, and I just want to go over. So the biggest thing is, does it make sense for you as an investor still? And, I mean, did it in the past? I guess it doesn't matter. And does it make sense for you as a borrower? So first, let's go through the actual mechanics of how peer-to-peer lending works and a peer-to-peer company, for instance. So there's a couple big players out there. We've talked about Lending Club right before the song. I mentioned Prosper as well. Those are the two big ones that are doing personal loans. And so the way that it works is the actual company is the lender. So the investor has actually purchased a note. So they've purchased a note or a bond, however you want to call it. And so it's basically tied to the performance of the loans the company's made. So the peer-to-peer company is the actual middleman. You as an investor are giving your money to the company. The company is deciding who to lend out the money to, and then the company is paying you based on how you said you wanted to invest the money. So which loans and which types of loans you actually wanted to invest it in. And so these notes are actually registered with the Securities and Exchange Commission, and the performance actually dictates, the performance of the actual company dictates what's paid out to the investor. And so the other hitch in all of this is Lending Club actually doesn't make out the loans. A Utah chartered FDIC institution called WebBank does. And so WebBank is the one who holds the money, and Lending Club again is purely this middleman who's deciding or who's handling all of the administrative parts of it in a way. They're the ones that are taking the applications. They're the ones that are reaching out to investors. They're the ones that are collecting the payments and things like that. The people who are actually making the loan and holding the money is this place called WebBank. So Lending Club is not allowed to actually hold the money, which is why they had to involve a bank who's
Right.
FDIC insured.
Well, that was the thing, because I, the one concern about having a peer-to-peer lending thing is, no FDIC insurance.
Right. Well, the thing is, you're still investing, so it's not like you can't lose all your money.
Right.
It's just that the fact that Lending Club didn't have the credentials, I guess, or the licenses to actually hold the money. They involved this other bank to be like the container.
Oh, you see, my thinking was that having the FDIC insurance would protect from fraudulent type of stuff.
That's actually for investing. It's called SIPC.
SIPC, right.
Yes.
Okay.
Yeah.
So the FDIC doesn't even do that.
No, they don't. And Lending Club isn't like a financial institution. They're just a middleman.
Right, that makes sense.
Yes, they're just the middle people right now. And so the interesting thing about this is, Lending Club plasters it all over their site. So you as an investor would go in and you'd say, okay, I want to invest in 100 different loans. I'm putting in $2,500, and that means $25 per person. That really spreads out your risk, right? Like if one or two people default, then you only lose $50. And on the other side of it, you get the return from all these other people. And so what's interesting is Lending Club has a stat on their site that says for investors who have 100 plus notes of equal size, 99% positive returns. The returns were between 5% to 8.5% based on the grades of the borrower, so between an A and C grade.
Right.
Which are amazing, amazing returns, honestly.
I mean, that's pretty ridiculous.
Yeah, just to give you an idea, like bonds, like government bonds were like, 1 to 3%. And bonds are probably the equivalent, not exactly in terms of risk, but in terms of like the type of loan, because you're basically loaning your money to the government by buying a bond too. So it's a similar thing.
And in terms of not crazy, like lose your mind type of risk investing, like higher than 5% is really unheard of.
It's fantastic. It is absolutely fantastic. And the other interesting thing about the peer-to-peer lending is you'd get paid every single month. So you would actually get that interest and collect it every single month.
Oh, word.
It
You're getting the interest and it's coming in.
Yeah, it's not like the stock market where you're investing in a company and taking ownership over it. You're saying, I'm lending you this $1 and you're going to pay me back $1.05.
But you're getting one of those pennies each month, though.
Mm-hmm.
And that's That's really
Pretty
good.
cool, right? Pretty cool. So
Talk about passive income.
yeah, totally. So the thing is, the biggest risk as an investor is obviously that your loans don't get paid back. So on the one hand, it is really about, okay, picking the A grade, taking a little bit less, and even a little bit less isn't that small. So Prosper's range of loans is between 4% and 7.5%. And all of these are actually net of fees. So after Lending Club takes their 1% management fee basically on the investor end, then this is actually what you get after all those fees are even taken out. I've been tempted to put some money in Lending Club.
I mean, really, a lot of this sounds really fantastic.
Yeah. Yeah. But, I mean, the fact that institutional investors got involved is really what's made me nervous.
They just mess up everything.
Well, the fact that they actually said in the New York Times article that there's not enough loans to go around. Like, some institutional investors, some investment banks have actually installed computer servers near the Lending Club headquarters so they could get the information just that few milliseconds faster than everyone else so that they could actually buy the loans before anyone else. That's how crazy it's gotten. Because listen to these returns, right? They're pretty amazing. They're pretty incredible. They're pretty unheard of, especially in this marketplace. So, yeah. I mean, it is, as an investor, again, as an individual investor, it's definitely tempting to try it. But one of the other risks is actually, this happened in 2015. A company called Trust Buddy in Sweden actually went bankrupt.
I mean, it was called Trust Buddy.
I know. I guess you shouldn't have trusted it, buddy.
Oh.
Oh.
That sounds so Canadian of you.
I know, right? So that's the other risk, I guess. And the thing is, Lending Club is huge. I guess my other concern really as an investor is, again, with the amount of loans getting bought up, is there enough to go around? And also, are you perpetuating, and this might just be more of an ethical question than anything, is like, are you as an investor perpetuating a cycle of debt? I don't know.
Well, I mean, if you're lending out money to people who need it and then they pay you back, that's working responsibly within the cycle of debt, or is that not really the case?
I mean, if it's so easy for a borrower to take these loans out, because also as a borrower, you get this money in like days instead of weeks or months, so you can get this money right away, and they're not collateralized, so you're not putting anything against this. So it's kind of like, it's kind of like taking out a chunk of money instead of a credit card.
Okay, yeah. I mean, that sounds a little nerve-wracking, but
yeah,
that's the type of thing that can stimulate a small business or a prospective small business that needs an infusion of cash really quick.
Absolutely. So, I mean, I might just try it and see, because I'm seeing a lot of, and Lending Club is doing this too, but I'm seeing a lot of small business loans being funded this way, being funded by peer-to-peer. Funding Circle is another one to look into as a borrower and maybe as an investor as well, is, hey, instead of doing personal loans, maybe it makes more sense to consider doing small business loans, which might be a bigger risk, because if you're a small business, that means that you don't have steady income and your business could fail and you could go bankrupt and you could file for bankruptcy and you could never see that money again. Or they could just pay their loan back, So it really is a matter of your comfort level as an investor. And part of it too is just like being mindful of the fact that the higher the risk you're taking, the higher the chance that you just won't get that money back.
My initial idea when I saw Lending Club name and all that, and the whole peer-to-peer lending, I was thinking that it was that it was communities helping small businesses and things like that, people needing money for various reasons.
Mm-hmm. Yeah, it just got really big.
And that's really the main issue, is the bigness of it, and that rich folks are coming through and getting involved, and they have so much. Well, it's not to demonize rich folks, but the fact that they have a lot of capital means that they're able to buy up so much that it skews what's going on.
Yeah, exactly. It's one of those proceed with caution situations, I feel like, and just the direction that it's going in. The other interesting thing too is Lending Club as a stock is actually not doing great at all. It didn't help that, the CEO just resigned. But one of the stats that they're finding, and this is actually heartening on a financial planning level, is that the loans being taken out are going down every year. So less and less people are needing this.
Really? Okay.
Yeah, the amount of loans are going down.
Is this because the...
I actually don't know if that's the correct correlation, though, or the correct conclusion.
Well, I was going to say...
Because it could be just that less people know about it, or the people who already know about it took advantage of it.
Right, and that plateaued. Or do you think it has anything to do with people being less afraid of banks now that we have more time away from 2008? Like, that's got to be a thing that's building back. I feel like it could be a number of factors like that.
Right, that's very true. So
also, there could just be a ceiling on how many people here are willing to take out loans in that fashion.
Yeah, that's true too. That's very true. And I mean, you bring up a good point that a lot of banks have actually loosened their lending purses, and you're seeing more competitive rates because of these marketplaces that are opening up, like peer-to-peer lending, or even like on the student loan side. Companies like SoFi or Common Bond, who are refinancing your student loans for a really low rate, they're using their own capital to do it. So they're not necessarily peer-to-peer, but they're also competing with banks in a completely different way because they've been able to make their processes more efficient than a bank would.
So one of the nice things that has come out of the banks falling apart and people trusting the banks less is they've gotten competition, so they've had to act more like a business.
Yes, exactly. That's very true, actually.
That's
that
great.
That is very, very true.
How's it feel, bank capitalism?
Yep.
What do you think of it?
Yeah, what do you think of it? What do you think? These startups are doing all right? The other thing that Prosper is actually, their stats are really interesting too. Since January 2011, they've kept up with the S&P 500, and the line graph is a lot more stable than the S&P 500. There isn't quite the same up and down. It's very much like it's almost linear what the growth is, and it's kept up with the S&P 500.
Wow.
And it is significantly outpaced U.S. government bonds. So the returns again for Prosper have been between 4% and 7.5%.
Are they doing anything different from Lending Club?
It's this exact same concept.
They just have people, maybe it's their name, I don't know. People are just feeling them better?
I mean, I think that Prosper is definitely smaller than Lending Club because they haven't been around as long, and also people just don't know about them as much.
Oh, and again, going along with the problems Lending Club are having because of the institutional cats, being that they're smaller, they're having less institutional people climbing all over their back, so they're able to grow more naturally?
Not necessarily.
So they're
institutional investors don't care which peer-to-peer lending company they're going with. They're just the smaller player. They just haven't been around as long.
Okay, so
people
so
know
their
less
upward
about
growth
them.
Is just...
People have heard of Lending Club in a way that they haven't heard of Prosper. Like, most of my clients are like, what do you think about Lending Club? They don't say, what do you think about peer-to-peer lending, or what do you think about Prosper? They say, what do you think about Lending Club? People have heard about Lending Club.
Okay, so it sounds like all the growing pain stuff is hitting that company more so than other ones.
Yes, absolutely.
Scrutiny, all of that.
Yep. And they just made themselves completely open to public scrutiny because they went public. So.
Right.
Yeah.
Right.
Completely open. So all of their books are on the table, basically.
It's so crazy that a Lending Club company that lends money to people became public so that you can buy pieces of the company where people loan. That's a lot of weird degrees of separation of investment.
Yeah, it's definitely like cycles on top of cycles of like, wait, so am I investing in Lending Club? Am I investing in the borrower who took out money from Lending Club?
Well, you kind of are, right?
Yeah.
You're at least making a bet on them.
Yeah, exactly.
It's like
this weird once removed thing.
Well, I wanted to get my consistent gambling reference. This so if you're buying stock in Lending Club, it's kind of like you're watching somebody playing craps and you're betting on them.
Oh yeah,
you're
saying okay.
Situation, right?
Yeah, you're saying like, okay, I think overall this is a good idea that you're lending this money to these people.
I don't want to lend money directly to this person because any one of them could default. But overall, I think they're going to do fine.
Overall, the company's going to be all right. Yeah, it's a very strange cyclical thing to be investing in a company that just basically moves money back and forth between people, right?
I mean, but that's what a lot of them do, right?
Yeah, I guess so. Lending Club is just like Nope, there's no pretense. We just take the money from this side and give it to this side, and that's kind of it.
Yeah, no like fake products or bad food or anything involved. It's
Yeah, no, that's just it. And just on the other side of it, as a borrower, I mean, the risks as a borrower are basically you can't pay the amount that you said you were going to. You know, it's just like any traditional personal loan. It affects your credit score. They do check your credit score, and it negatively affects it when they do. Not very much, but it does. The other thing too is that if you default and you can't pay it back, basically, then it goes to collections and goes through that whole process. And you also lose the flexibility of credit card payments. So by consolidating your debt, for instance, if you're like, okay, I just need to have one payment and lower my interest rate, by doing that, you actually take away the flexibility of the credit card payment, because you're saying, I'm going to pay this exact amount every month for 3 years or 5 years or 1 year, whatever amount you pick. And if you lose your job, or if you suddenly make less money that month, or you can't meet your budget that month, then you still have to pay that amount. You can't reduce it. You can't just pay the minimum, any of that kind of stuff. So,
well, I mean, that's the minimum.
Yeah, that's the minimum. That's it. That's the minimum and the maximum and the final number. And so that is definitely something to take into
Oh,
consideration.
yeah, and you can't speed pay it off or anything.
You can pay it off. You can pay it off without prepayment penalty. That's one feature of
Oh,
Lending
okay.
Club. Yeah, so you can pay it off faster if you wanted it to. But for the most part, it's just like, okay, this is the minimum amount that I absolutely have to pay no matter what. And the thing is that the psychological risk, or I guess the habitual risk, is you pay off your credit cards with this debt consolidation, and then your credit cards are clear, and you can potentially go back into credit card debt because you're like, oh, I cleared my credit cards. I'm going to keep using my credit cards while I'm paying off this debt. So now I have credit card debt and this personal loan.
I see what you're saying about perpetuating the cycle.
Yes, exactly. So you pay off the credit card debt free and clear. You're like, ooh, I have my balance back, right?
But, if the question is, if this is doing for people what they need in terms of their small businesses, if they're getting married, they want to travel, they need a car for a thing, things like that, large purchases they weren't prepared for. And for the most part, especially, considering they're trying to keep it prime for the most, what's the catch?
Yeah. I mean, for the borrower, not really anything. It's kind of nice. What's interesting is, I think it was one of Prosper Lending Club had an interesting story where it was an actor who needed to take out a loan for something. And one of the first lines he said was, I checked it out. I checked with my financial advisor. He gave me the thumbs up, and so I did it. And so it's one of those things, too, where it's like you can talk it out with somebody and decide if it's right for you. And it's just another tool to have in your tool belt, basically, when it comes to money.
I want to know something about a detail in that story. Why did it matter that they were an actor? I thought there was going to be something acting related to that.
Oh, no, I just remember that he was an actor.
You're like, there's an actor who took it out, and then when they came for his money, he said he was a different person. Put on an accent, changed his posture and everything. It was a good scam.
I have no idea why they specified that he was an actor, but it was just something I remembered.
So actors take out loans? Or
Only if your financial advisor approves.
Right.
Is the moral of that
and
story.
it has to be an actual financial advisor. This should not be a peer who is acting
No.
like a financial advisor.
No acting peers acting like financial advisors. So, I mean, it is definitely a viable option as a borrower. On the investor side, since I personally haven't tried it myself, and not that, I have to try everything before I recommend it to people, but I kind of like to know what it feels like to have my skin in the game in something like this, because it is still relatively new. Like, Lending Club didn't exist before 2007.
Can we do this from both sides? Can we borrow from each other?
Oh, man.
And do it. Both of us do it on both sides, so we even out.
So I borrow from you and you borrow from me.
Right, and we can see how
That's
well it goes.
Some real peer-to-peer lending right
See,
there.
can we trust each other to pay each other back? Who ends up not paying the other back?
I know, right? Uh-oh. Here we go. So that's the thing. That's basically it with peer-to-peer lending. And I think we need to go to a song right now and kind of talk about how investors have been kind of manipulating the system. We're going to talk about redlining a little bit. If you haven't heard of it before, It's a very, very controversial practice, but also perfectly legal the way that peer-to-peer investors are doing it. So it's a very interesting loophole, I'd say.
It is. And again, remember, loopholes are the things that they used to shoot arrows at people walking by.
Ooh.
Remember that
Ooh.
redlining. Yeah, if you guys know about loans and investing, that you know that redlining is some grimy stuff. So we're going to rock with, since we were talking about Prosper, we're going to rock with my homie Rock Most out of Atlanta, Georgia. He got a song from the record Rise and Shine called Prosper, and we'll be back in a minute. Bunch of Budget, Bonfire Radio. And we're back. Brunch and Budget, Bonfire Radio. That was Rock Most out of ATL with Prosper. It's a song, not the name of the company that lends money to their peers.
Yes, no, it's not a peer-to-peer lending, but I like the theme. I'm into it. Way to keep matching songs with the topic.
Yeah,
like you've
yeah.
been doing for so long.
Thank you for our sponsor, Google.
They've done a great job so far, I think.
Helping us search the easiest crate digging in the world. Man, that's great. No, actually, that I can do that because I love being able to play indie artists from around the world and not having to actually go to the little record store and dig through vinyl because, most of these cats ain't put out no vinyl.
They're on Bandcamp.
Vinyl's expensive.
Vinyl is expensive. So thank you, Prosper. I love it. Prosper the
No, that's the name of the
Prosper
song
the
is
song.
Prosper.
Yeah.
You can thank Rock most.
Thank Rock Most
For
for your
making the
song
song.
Prosper. Now we're going to talk about redlining.
We don't do that enough. Can we thank artists more often? Thank you, artists, for making a thing.
Thank you, artists, for making a thing and making our show a lot more robust. I'm into it.
Yeah.
Yeah, awesome. So redlining. Redlining, if you've never heard of it before, is basically an illegal practice. Financial institutions basically, without specifically saying we're not going to lend to a certain race or to a certain socioeconomic class or in a certain neighborhood, basically found ways to make it impossible or extremely difficult for people from those neighborhoods or those ethnic or racial backgrounds to actually be able to borrow money.
Our Broadway fans may be familiar with A Raisin in the Sun.
Ah, yes.
Classic play and film, Sidney Poitier, all sorts of wonderful, talented folks. And that was the situation there, where it wasn't exactly that you couldn't do it.
They didn't say, no, we're not lending you money because you're black.
And we're not going to let you. Yeah, there's all the. Well, there's a lot implied there.
Yes. I guess it's similar to, like, giving you tests before they allow you to register to vote kind of thing. There's all these extra hoops that you have to jump through if you are in a certain socioeconomic class or in a certain race.
Well, I mean, anybody in any position knows how it's easy to make it harder for any specific person or any background group, and it's often easy to do so while remaining within the parameters of the law.
Yes, exactly. And so redlining was specifically made illegal in 1968 as part of the Civil Rights Act. And what's interesting is they are using the term redlining to describe something that some investors have done in their peer-to-peer lending investing. And so
I can see that coming in this kind of industry.
yeah, the thing is, though, that the investor has no idea what the race is or the ethnic background or even necessarily what city they live in.
Yeah, do they get much information about the loan at all? Do you even get to find out what it's for?
Here's what you do find out. No, you don't get to find out anything. All you know is that the borrower is a certain grade, and you've decided based on that grade that you're going to choose to invest in them or not.
That's so interesting because I feel like if someone wanted to make potential peer-to-peer lending company builders out there, if someone were to get all social about it, social media, and maybe don't have the picture of the person, maybe don't have the name or anything like that, but if I could see a few different things and a few different dreams that I would be invested in, I might be more excited about doing so.
Yeah, that could be a cool. Maybe we should start a peer-to-peer lending company dialect.
Like I said, I lend to you.
You.
lend to
That's
me.
how we start. Let's see how it goes. What's the return going to be?
Start
right?
the circle small.
Well, here's the interesting thing about the way that they're redlining. And the thing is, this is interesting because it's not illegal. It is completely based on statistics. And what they found was that Florida residents have the highest default rate of any other state. So the default rate in Florida is 6.21%, which means 6.21% of borrowers don't pay their loans back. The national average is 4.93%.
So it's significantly higher
It's
statistically.
significantly higher, yeah. And then in states, in Indiana, it's 2.25%, and in Tennessee, it's 2.8%. So some investors are like, I am not putting any money in Florida. Just based on statistics, just based on like, hey, they're probably not going to pay me back like someone in Tennessee is going to pay me back.
And what's funny is when things remain faceless like this, and
Yeah.
again, when you don't know what dreams people are investing in.
You don't know what dreams, you don't know where they're from.
It doesn't
specifically.
sound that unethical
It just sounds like
on
oh,
face value.
Yeah, no, totally. It just sounds like, oh, I'm making an educated bet, right? It's like the odds are.
And this is part of the problem, though, because then the result is but many real people in Florida get screwed over.
Yeah, they can't get loans. And it's not like all investors are doing this. And 6.2% out of 100% is really not that high, even in the grand scheme of things,
Well,
right?
yeah, it's not that terrible compared to 4. It's still fairly unlikely.
Yeah. So that's the thing. And not many investors are doing it. There's just investors who are like, I'm going to squeeze every dollar out of this investment.
Does this portend to more insidious types of redlining, more overt types of redlining?
I don't know if it can because the investor, again, doesn't have that much information.
Right.
They again are mostly dealing with the lending club company and not the lending club company. They're mostly dealing with the peer-to-peer lending company.
Man, that's how these guys got managed to Xerox up their name.
I
'Cause they're
know,
just
right?
like, we're the people who lend.
We're the lending club. But yeah, so the lending club or Prosper, whatever
Ooh,
peer-to-peer
ours is going to be
company-
called the Money Havers.
the money havers.
I want to go to the
Just
Money Havers.
straightforward.
And our
They
slogan
have
will be,
money.
we got the money.
I'm into it. It's happening. We're Shark Tanking this right now. So the thing with these peer-to-peer companies is they're not allowed to release this information, right? They're not allowed to release the race or the geographical location or the gender, anything like that of the person. So technically, this small bit of information that the investor is having, it's not illegal. They can't regulate it.
I love how they're like, we only get a tiny bit of information and we're going to discriminate based on whatever we can find. I think part of that must be just xenophobic, jerky folks who like to discriminate. And they're like, what? Can I discriminate on something? Yeah, there's something. Let's go with it.
But I feel like it's less personal than that.
No.
even.
It's a money thing. I'm making a
Right,
joke.
it's a completely a money thing.
One thing I wanted to be sure about. So there's no incentive and no reason for this redlining to end up bleeding over into the peer-to-peer company itself.
No, they're just the middlemen. They're
That-
like,
that-
we're
that
going to
really
take
doesn't help.
we're just going to take the borrowers, and as long as there's people on the other side who are investors, then they'll be able to borrow money. And it's such a huge, another name for this that people have called it is crowd lending, because it's such a huge pool of money on one end and a huge pool of debt on the other end that chances are you'll be able to find a match.
Right. Well, it definitely does sound very crowdfundy.
Yes.
But in actually, even though you're not finding out about what you're funding, it seems like a kind of more authentic way.
Yeah.
Or it sounds more like what I thought of when I first heard about crowdfunding.
Right, exactly. It's like, you're lending me money and I'm going to pay you back for it in a little bit of interest, right?
Oh, an awesome thing, borrowers, you don't have to make up silly perks.
Yeah, you don't have to take people out to dinner or send them a T-shirt or something.
No, those are good perks. Those are awesome perks. Perks are usually like, we put a thank you on our Facebook page, and then the next tier is we write your name in the program. Like all sorts of stuff you don't need.
You're like, what? What is that?
Give me a T-shirt. I'll take
Yeah.
a T-shirt, especially if you're a T-shirt company. Yes.
That's
what
true,
you do.
actually. That's true. Maybe our next show will be advice on perks for crowdfunding.
Since you just since Pam just knows all the perks.
I know
What's
all the
another one?
perks.
Just throw one out there. Like, what's a good perk for crowdfunding?
Backpack.
Backpack. Look at that. Like custom-made backpack.
Yes, it has your name and specific colors on it.
Can it have solar panels on it too?
Oh my God, if you want. Yeah.
Custom-made solar panel
That's
backpack.
the next tier.
This is what you guys have to give as your perks for funding your play or whatever you're doing.
Yeah, or you could just take out a loan from Lending Club and buy one, I guess.
Right? And then you might have extra money left over to buy your own solar backpack.
Whoa.
There we go. Solar backpacks for everyone.
Solar backpacks for everyone, thanks to peer-to-peer lending. No, peer-to-peer lending though, I've been trying to think about how I feel about it. Still, I'm not convinced. I don't know what the future of it can look like because it's still so new. Like in the grand scheme of financial institution-ness, it's not even 10 years old yet. 2007. It hasn't really been around. It hasn't been around for a decade yet.
Well, I mean, in concept, it's been around for
In concept,
a while.
Lending Club was not the first, but they're the ones that really made it mainstream.
Yeah, that's...
They're the ones that popularized it, and that was really only... And I think it all honestly really happened because of 2008.
Well, that's what I was about to ask you. It's like you think that this would have blown up as quickly as it has if not for everyone losing trust in the banks.
No, and I think that they set a model and a precedent for a lot of other companies doing it, and they're getting their money in different ways, but they are changing how lending happens and how debt is paid back and things like that. That's what's so intriguing about companies like Funding Circle and SoFi and even like debt marketplaces. So Credible, for instance, is a company where you can actually shop around for other institutions that will lend you money. So Credible is like a middleman for the middlemen.
We talk a lot about things like the sharing economy and breaking down gatekeepers, or at least traditional ones. And this actually seems like it's doing that, or it's born out of the
Yes.
gatekeepers, letting the gates rust.
Yeah. Yeah, it's.
What are you nervous about?
I think I'm more nervous about big fish coming into play in this little pond right now.
What other sorts of disruption can these big fish do? Like, is the big worry that they're going to come in and drain it, and people who borrow will still be able to get money, but the common person won't be able to get involved on the investing side?
I think so, and I am also worried about because big institutions are pretty much faceless. I am worried about the idea of Lending Club being looser about their lending standards and changing their standards so that they can offer more loans and make more money off the loans. So,
Well, and one thing this is the thing that springs to my mind, and while Lending Club or any of these peer-to-peer places don't have an incentive to discriminate, but they do have an incentive to collect data and do things with their data.
yes.
And I think that the more we get larger companies involved, the more pressure they may put. Because, I mean,
Yeah,
how
absolutely.
many big old groups of people are going to be happy with just knowing what state they're from?
Right?
Not when they know they
That
can make better
they have
decisions
more. Yeah.
based on other stuff.
Yeah, even just knowing the zip code, right? Even just having that little bit of information, knowing what city they live in. And then looking at what the ethnic and racial makeup of that city is.
And if that happens, that changes the game completely.
Right. And it's not to say, again, this is why I'm cautiously optimistic, you know? It's not to say that that's going to happen or that they're even going to go there, but the fact that institutional investors are like so hungry for this right now, it's just it's something to make you think twice, you know? And maybe now if you're listening to this and you're like, maybe I want to get in the game on one side or the other, maybe now is the time to do it. And maybe now is the time to be like, let me test the waters while it's still new. It's still something that, you know, conceptually is as simple as it sounds, right?
Yeah, I hear you.
You know, and it's something that you can truly understand. Like, I'm lending money to this person so they can do this thing. So I'm saying I don't know how I feel about it yet because it's so right in the middle of the story.
Right.
That's the reality of it.
Well, being that we're in the middle of the story, it feels like we still have an ability to affect it.
Yes. So I am going to dip my own toes in the water and let you know.
It's dipping time.
We're dipping our toes in the water. I'm going to put some money into Lending Club or Prosper. I'll let you know which one I pick. Maybe both.
Or maybe some whole another one that we
Yeah.
haven't heard of because we haven't researched
Yeah,
enough.
I like the idea of investing in small businesses. Let's see what happens. This could be a
maybe
really
the
cool
We
way.
Have Money company.
The We Have. What about Money Havers?
The Money Havers. I forgot the name of it.
I think you just want to start a whole other thing. I
No,
was
we're
like,
rebranding.
We're rebranding, yes, exactly. So stay tuned. It's not going to be next week. It'll probably be some time from now. We will have an update for you on our own personal experience with peer-to-peer lending.
All right, peer-to-peer lending sounds great. Thanks for listening today. If you enjoyed what you were hearing, leave a comment on our iTunes. Check us out on TuneIn. Download the episode, pass it around with your friends, make mixtapes of us,
Oh, and then send that to us.
and give that not to us, to like people you love and stuff. Like you want to
Oh.
ask somebody out on
I
a
was
date.
thinking you were going to, like, mix it into a song or something.
No, you could do that. I'm just saying, make mixtapes of us for people because like we're romantic like that. You know,
Aw.
especially about your money.
That's
If you
right.
love yourself and love your money. This is the Brunching Budget. We'll check you next time. We're gonna finish out with a song called "Borrow" from JPN out of Japan, and we will check you next week. Brunching Budget, Bonfire Radio. Peace.